Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can find me on Twitter at xbordertax. On this week's episode of Cross-Border Tax Talks, we're back in our D.C. studio, where I'm excited to be joined by Nita Asher. Nita is a partner in PwC's Washington National Tax Services Group, specializing in international taxation. Before joining PwC, Nita was the legislative counsel at the Joint Committee of Taxation during the very important years of 2017, 18, and 19, when the Tax Cuts and Jobs Act was enacted. Nita, welcome to Cross-Border Tax Talks.
Happy to be here, Doug.
Well, I'm very excited to finally get you on the podcast. We're going to try to squeeze all of this into 30 minutes or so, but we had Kevin Livingston and Carl Russo on the podcast, several months ago, and they really shed some light on how the Joint Committee of Taxation works, how both helping from a legislative process as well as an economic and budgeting process, how they interact with the Senate and with the House. And so we're not going to dive into that. I would encourage listeners that are interested in how that process stuff works to listen to that podcast. But we're here today to talk a little bit about some of the new BEAT finalized regulations. But before we really dive into that, my first question for you is, what is something that you learned or something that surprised you from your almost 3 years at the government, that because you were in private practice before then, what's something that surprised you as far as being in the government? Because I wonder myself what that experience would be like.
Yeah, I think, Doug, what surprised me working on the Hill was sincere interest in international tax issues. And I think it's partially because, there's been recent articles that you see in not only the tax press, but in widely circulated periodicals such as, The Economist to The New Yorker, talking about international tax issues. And so when I joined the Joint Committee on Taxation in 2017, I thought, I'm only going to be working with folks who are specialized in international tax issues. And it was quite remarkable, just the questions coming in from folks that you didn't think really had constituents that were concerned with very technical international tax questions. They were sending in articles from the Wall Street Journal saying, hey, this is something that, my Congress person wants sound bites on. Can you help us think through how we can respond? And so that, to me, was an aspect of the job I wasn't quite anticipating, but I thought it was very interesting.
No, that is. And if you think about what's happened since then, we had Will Morris on the podcast before. We were talking about BEPS 2.0 and the digital service tax, and I think of all those changes, and those have been in the mainstream press as well. It's been odd because my mom, who's a school teacher, has asked about international tax topics to me twice within the last month because of all the press with the digital. She's like, do you know about this stuff? I was like, oh yeah, Mom, that's what I do. And like the fact that my mom, who's a retired school teacher, is asking those questions tells you a lot about where international tax, and I think a lot of that momentum started with the TCJA, and we've really created this blueprint now that the rest of the world is thinking about adopting with Pillar 2. So one other really something that has fascinated me, and I'm excited to be able to get a little bit of insight, but we could probably dedicate an entire podcast to this, is the BEAT versus the BAT. Right? When tax reform was originally started to happen, there was, I think it was the House that originally came up with something called the border adjusted tax, and then the Senate came up with this base erosion and anti-abuse tax. And I'm interested in learning a little bit about, kind of how that went down, and I assume revenue was probably one of the big drivers. But first of all, the BEAT actually became law. So why don't we start there? What is the BEAT?
The BEAT is a tax imposed on certain large corporations to the extent they make base erosion payments to foreign-related parties that result in base erosion tax benefits. And that's a defined term of art. Generally refers to deductions and other specified, tax benefits. The BEAT also serves as a minimum tax in that to the extent that a taxpayer's modified taxable income multiplied by the applicable beat rate schedule is greater than their adjusted tax liability is a certain amount, then you're subject to the beat. Mm-hmm. So it's kind of, multifaceted. And
so just to clarify on that, so what taxpayers are required to do under the base erosion and anti-abuse tax is they have to come up with this new modified taxable income calculation, which requires them to add back certain deductions.
That's right.
And then you multiply that number by 10%. And if that amount is more than your ordinary tax liability, then you're in the beat.
That's right.
And one of the things that we talked about, and we'll get to this a little bit more in the conversation, is what we referred around here as the GILTI whipsaw or the GILTI boomerang. There's a number of different terminologies, but particularly for U.S. multinationals, and we've dedicated some time to this on the podcast as well before, that to the extent that a particular U.S. multinational or even a foreign-based multinational with subs underneath the U.S., to the extent that they end up in the beat that their modified taxable income times 10% is more than the regular tax liability, that can be a huge number because you don't get foreign tax credits when you're in the beat. And so effectively your GILTI is subject to tax at the 10% without the FTCs. And so we'll talk a little bit about some of the relief provisions that we've seen in the proposed regs and as well as in the final regs, but that has been a really big issue, particularly for US MNCs. So that's what ultimately became the final law. But when the House originally proposed its bill, there was something called the border adjusted tax, which had a lot of people in panic. Remind us what the border adjusted tax.
So I think you have to actually start back in 2011, where Chairman Camp had proposals in the House, basically proposing to bring down the corporate tax rate, but in order to do that, there were certain base erosion protection mechanisms that were proposed, as well as, other tighteners and other provisions in the international tax, framework. And then the House, now you're with former Chairman Ryan, introduced a blueprint prior to the 2016 presidential election. And the House blueprint also proposed to bring down the corporate tax rate. And that's, in an effort to keep U.S. MNCs still located here in the U.S. There were a lot of redomiciliation transactions happening, around that time that Treasury was, having to issue guidance in order to manage. And there was a lot going on, how do we keep companies in the U.S. and also paying their so-called, fair share.
Right.
And so the blueprint, in its proposal to, lower the corporate tax rate, also had this border adjustment tax or destination-based cash flow tax, which instead of looking at where goods are produced, it's actually a tax on goods based on the location of consumption. And so it's, an interesting, way to potentially raise revenue in order to pay for a lower overall corporate tax rate.
Sure.
And so then you go forward into 2016. We had an election in November. And after that election, because of the configuration of the Senate and the House and the administration, folks started, I think, more seriously, in my opinion, looking at the House blueprint. And while the House was trying to answer some of the questions with respect to the location of consumption, you had the Senate working on their sort of beat proposal. And as you noted, Doug, because reconciliation was the procedural process utilized in order to enact 115-97 or TCJA, revenue mattered. And so while the House was grappling with their, proposal on how to raise revenue and answer some of the, more difficult questions, you had the beat coming out of the Senate, and as folks, estimators were looking at the numbers, it, seemed to be, at least for now, the beat was ultimately what the members were asked to vote on.
And a couple of things. So, and I guess as part of the Joint Committee, like your guys' responsibility is really working with both both the House and the Senate and helping think through the economics related to that, and then obviously some of the technical parameters. I know one of the big differences, in particular with the BEAT, that I think taxpayers as well as advisors found some relief on, the cost of goods sold was not intended to be included as part of the BEAT. So in other words, to the extent that somebody was purchasing goods, that might otherwise be subject to the BEAT, that from a related party, for example, that was carved outside the BEAT. And I know that was one of the major differences where I think taxpayers were pretty excited about.
You're right, Doug. As probably Kevin and Carl noted on their podcast, the Joint Tax Committee, it's nonpartisan, bicameral. They advise both the House and the Senate and also work with Treasury. And so I do think we need to acknowledge that during the process and folks thinking through the BEAT, and also the House's proposal for a net basis BEAT-like provision, but also had the excise tax component. Treasury was also, helping and advising on those particular proposals.
Yeah, what a fascinating process. And we talk about 2016. I mean, what a long 3 years ago it seems, as far as for people in the industry. There has just been a phenomenal amount of changes.
Yeah, and no lack of reading material.
No, so let's get to that. Okay, so I think many of the listeners are here for us to talk a little bit about the new BEAT final and some of the proposed regulations, which I think many of us in the industry would say might be the most taxpayer-friendly rules that we've seen. I think that's certainly up for debate, but I think there were a lot of points of clarity. I think that if there's one thing that we've seen throughout all these reg packages is that the preamble to the proposed regs are very thorough, particularly with respect to addressing comments and a variety of issues, which I certainly think is very helpful as an advisor. So I appreciate all the thoughtfulness that has gone into this. But we're not obviously going to go through all the details of the BEAT, but I did want to talk about a few provisions that I think are of interest to a number of taxpayers. The first really is, there were a number of comments, as well as, there's just been a lot written about whether payments, so particularly, let's say, interest and royalties or whatever, deductible payments to controlled foreign corporations. So if you are, a U.S. shareholder or a U.S. corporation and there's foreign subsidiaries, and then you're making payments to those foreign subsidiaries, those are deductible payments to a related party. But because of the nature of our GILTI regime and or subpart F regimes, that oftentimes that income is subject to, almost more than often, most of the time that income is subject to immediate U.S. tax. It depends, obviously, how your GILTI computations work out, if you got tested losses, et cetera. But most of those payments are either going to be subject to U.S. tax, either as GILTI or subpart F. And I think a number of people said, well, if that's immediately subject to U.S. tax, then why should that go into our BEAT calculation? And I think some of us were hopeful that we might be able to get that, because that goes back to the GILTI boomerang issue or the GILTI whipsaw, that a number of U.S. MNCs that have these because it's also for R&D, right, which is pretty common, besides royalties, interest, any types of deductible payments. Those payments are made. Companies end up in the BEAT. They don't get their foreign tax credits for GILTI, and the difference in cash and effective tax rate could be huge with some of the modeling that we've done. So we did not get that. We did not get that exception in the final reg package for GILTI or BEAT. And do you have any insight? I'm sure treaties, I'm guessing, played a big role, but talk a little bit about that.
Yeah, I think your point, Doug, about the preambles, not only to the proposed regulations, but final regulations, are quite detailed. And Treasury and the IRS noted that several comments were received with respect to GILTI, sub-F, PFIC inclusions, and how back in 2018, when the first tranche of BEAT regs came out, Treasury and the IRS were able to provide for an ECI exclusion, which may or may not be sanctioned by the actual statutory language, but they were able to find the authority to provide a regulatory exclusion with respect to ECI payments.
And ECI is income that's effectively connected to a U.S. trade or business, so income that's subject to tax in the U.S. would generally require some type of 1120-F or similar return.
That's right.
Yeah.
And commentators were trying to analogize the, inclusions on with respect to subpart F and GILTI, saying if you're treating ECI this way, why can't you treat subpart F and GILTI inclusions similarly?
Which doesn't seem like that big of a stretch.
It does
admittedly.
not. I mean, I think that is, a good argument, but Treasury and the IRS did a very good job, in my opinion, distinguishing ECI from subpart F and GILTI inclusions, and then went on to talk about some of the practical implications. And as you noted, Doug, what's not specifically commented on in the preamble, but should be considered, treaty challenges. I mean, we also, we had movements with certain protocols in Senate Foreign Relations Committee this year. There's a stall with respect to new treaties because of the request from Treasury for beat reservation language. If you exclude subpart F, GILTI, and PFIC inclusions from the beat, I wonder whether or not you have to grapple with a lot of concerns with respect to non-discrimination under our bilateral treaties. So I think there's, that is ultimately why in the final regulations, after, much consideration, Treasury and the IRS are not willing to go. And, the BEAT is a new tax, and I would hope that, it's subject to evolution and refinement in the future. And this could be a case too where Treasury and the IRS said, if you want this type of exclusion, you should talk to your, congressional members and try to, lobby or advocate
Need a
for one.
statutory change. And just so that the listeners understand, I think the non-discrimination issue would be that if the U.S., let's say, is making a payment to France, which may not be the best example with the digital service tax, but we'll go with that. If the U.S. is making a payment to a French subsidiary, and that's not subject to the BEAT because it's a subsidiary of the U.S. and with the U.S. MNC, and that would be exempted, but then a U.S. multinational or a foreign-based multinational is making a payment from a U.S. to a French company that is subject to the BEAT. It raises those questions and issues. So we will talk about some other alternatives, which is really kind of disclaiming some of the deductions, and so there is some self-help I think that companies can do if they fall into the BEAT. But before we go there was also a lot of discussion about netting. And whether companies may be able to net payments to be able to try to reduce the BEAT. Talk a little bit about that. I know that was something that a lot of companies in a number of different industries were focused on. Right.
And quite a bit of the preamble to the final regs is dedicated to, netting or so-called middlemen or pass-through payments, and Treasury and IRS are unwilling to give any sort of broad netting exception, which taxpayers were hoping for. That being said, there's a new regulatory text rule which, clearly states the definition of whether or not something's a payment or accrual is determined under U.S. tax law. So to the extent that a taxpayer can rely on conduit or agency or cost reimbursement, theories in order to argue that their payment ought not to be subject to the BEAT, you have guidance there, but there's just no broad netting exception provided for in the regulations, unfortunately.
Yeah. But your point is that there's lots of case law and other things to hang your hat on. Where I've seen it quite a bit is particularly services businesses.
Oh, absolutely.
That it's not uncommon for global services business to contract everything through the U.S., right? Given our corporate law, just a number of reasons why you would want to have central contracting to go out of the U.S. Well, if that central contracting goes out of the U.S. and then the U.S. company then has to reimburse the rest of the world for services that are being performed with related parties, then obviously the concern is are those payments subject to the BEAT? And you have to look at one of these alternative theories. And I do think it was helpful. Obviously, I think many taxpayers would have loved to have seen a specific exception, but to acknowledge that there are the other areas and that it's based on U.S. tax law principles, I think at least was somewhat helpful.
Right. And, it's basically, in addition to modeling, you now need to dust off your agreements and make sure that you have the, necessary language in place to actually, make one of these arguments and appreciate where the benefits and the burdens with respect to activities and, the flow of funds actually lies.
Right. So I think the biggest relief, at least in my view, for taxpayers with respect to the BEAT is the ability now with the proposed regulations to potentially disclaim or waive certain deductions. Now, this seems like a draconian kind of self-help, right, where a taxpayer would have to say, all right, I'm going to walk away from a deduction to a related party that I would otherwise get a deduction at 21%. Such that I would not end up in the BEAT. So after you do your calculation that we described before with your modified taxable income times 10%, you'd either want to take a deduction to actually get you into the safe harbor, I think, below 3%, or such that your modified taxable income times 10% is less than your U.S. tax liability. Right. But talk a little bit about that exception and how does that work and how does it operate? And it's retroactive is kind of at least the way I'm thinking about it. But talk a little bit about that.
Yeah, I mean it's retroactive, but taxpayers relying on the voluntary election to forego deductions in the proposed regs have to apply all of the provisions in the proposed regs, and there are certain anti-abuse rules with respect to partnership structures and the aggregate group rules that will also have to be adhered to.
Great point.
And so, Doug, let's, stepping back a bit, prior to the recently issued proposed BEAT regs, there was some discussion with respect to the difference between allowable and allowed and whether or not, taxpayers could walk away from deductions in order to right-size, their amounts of base erosion payments and fall under the 3% threshold. Mm-hmm. So that was a point of discussion and a need for additional clarification. And it appears that what Treasury and the IRS have done is they went in and provided a procedural process with respect to just foregoing deductions. And as you noted, it seems to be truly in the spirit of helping taxpayers who are close to the 3% threshold right-size their base erosion payments, and they can make the election on their original return, an amended return, or during the course of audit. And it's it can be retroactively applied to the extent they're applying all the other provisions of the reg. So it's truly trying to help taxpayers. And to your point earlier, Treasury and the IRS couldn't find the authority to provide a subpart F, GILTI, or PFIC inclusion carve-out, but maybe, some of the U.S. MNCs that are potentially subject to the BEAT because of their FTC profiles or something else, they can actually benefit from this tool in the proposed regulations. And I think it should be noted that the voluntary election is made on an annual basis. So you're not wedded.
Not stuck.
Right, and it's based on initial reading, it is, an amount of a deduction. So there's a lot of flexibility here. I think, though, currently you've got both a discussion in the proposed regs, in the regulatory tax as well as in the preamble, when the election is disregarded. And I would not be surprised if, at least when the regs are finalized or when comments are received in February of 2020 on the proposed regulations, we see additional commentary and guidance with respect to when the waiver is disallowed. And, can taxpayers forego a deduction, increase their taxable income, and benefit from a 250 deduction?
Right.
For example, that's not specifically addressed right now in the proposed regs, and we might see more guidance in that area, but it really seems to be a useful tool for taxpayers to rely on.
And your point on that, Nita, is like those downstream consequences of foregoing the deduction. So in other words, you forego the deduction because you want to avoid the B, you want to get below the 3%, but then presumably foregoing that deduction just gets pushed through, if you will, the rest of your return. And so maybe you're no longer in an NOL as a result of foregoing that deduction. If you're not in an NOL, then you can take advantage of this Section 250 deduction, which we spent a lot of time talking about, but effectively get 50% haircut on whether it's foreign derived intangible income or GILTI, for example. That's and so, it's we've used the analogy, the whack-a-mole, a lot on the cross-border tax talks in the foreign tax credit space, in the GILTI space, and now in the BEAT space as well. It's just like these things have multiple consequences, and modeling it all out is really important.
Absolutely.
To understand
I mean,
the
to sound probably repetitive here, just the interaction of all these rules is really important.
Right.
And so there are pieces there. I mean, we're expecting 163J guidance, any day now, either late this year, early next year. And I think some questions with respect to the interaction of the BEAT rules and 163J, are still sort of up in the air and, subject to further interpretation and guidance.
Right. And we're over 2 years into this too. And new issues keep coming up, and how the interactivity, it's fascinating. So let's move, because I do think, just to reiterate, that the ability to potentially waive or disclaim deductions, very taxpayer friendly, and just at least gives, particularly for taxpayers that are close to the 3%. My concern would be if there was some macroeconomic change that companies try to do their modeling, they think they're staying below the 3%. Well, if U.S. profitability would dip for whatever kind of macroeconomic factor, you could all of a sudden, a taxpayer could all of a sudden end up in the BEAT, even if they were doing everything in their power to try to, manage that issue. There's just a lot of things out of taxpayers' control, and at least this waiver process provides an ability to try to avoid the whipsaw or the boomerang that is GILTI. All right, so let's talk about something else as part of these BEAT rules that has garnered a lot of discussion, and that is onshoring of intellectual property. I think that one of the things that has been stated in some of the preambles, and as well as the to the actual legislation, I should say, and in plenty of panels and articles, is the FDII combined with the BEAT, and this goes back to actually Chairman Camp's proposal, kind of the carrot and stick, that there was, they wanted to try to, if not incentivize companies to bring IP back, at least create, parity between where companies have their intellectual property between the U.S. and offshore, and we spent a lot of time with that. But so we thought, as a result of the BEAT, where maybe U.S. multinationals have IP offshore and are making royalty payments, or even foreign-based multinationals, that the BEAT would encourage companies to onshore IP either back to the U.S. or into the U.S. to stop these base erosion payments. Well, one of the challenges is that, how companies go about doing that, because if you bring back IP to the U.S. from a related party, and there is amortization associated with that, then that amortization could then go into the BEAT. So instead of having a royalty payment that was subject to the BEAT, the depreciation or the amortization associated with this asset would then go into your BEAT computation. And there are some exceptions as far as how that rule operates, but talk a little bit about that and how the final regs kind of change the game with respect to how IP can come back to the U.S.
Right. And definitely an underlying principle of tax reform was also, encouraging the return of assets and people to the U.S. And surprisingly, back in 2018, with the first set of proposed BEAT regulations, the government took a very broad approach to the definition of base erosion payments, and basically said, you could have a base erosion payment by way of a non-recognition transaction in the mere, exchange of stock. And taxpayers really, paused and felt not only did that broad approach conflict with the underlying policy of tax reform, but it was also, just impacting, restructuring that was going to occur as a result of the lower corporate tax rate, too. And so basically, Treasury and the IRS received a host of comments on the scope of the definition of base erosion payment, and thankfully reversed their position with respect to non-recognition transactions and carve out certain specified non-recognition transactions. So those are, sub-C types of 355, 368, 351 transactions from the scope of, the definition of base erosion payment. That being said, there's now this very strict and broad anti-abuse rule
Yeah,
that we're already starting to see comments on in the tax press by government officials.
Right. So before we go to the anti-abuse,
Yeah.
because I think that's fascinating as well, just to make sure that the listeners are clear that, imagine a U.S. MNC with a subsidiary that holds, IP through a controlled foreign corporation. Maybe that IP was recently acquired in a transaction just directly so that the company has basis in that, right? Then and basis in that intellectual property. Well, under the original proposed regs, just a liquidation or a domestication of that entity generally and then that IP that comes back to the U.S. with basis, that even if it's in a non-recognition carryover transaction, the proposed rules would say, well, the deemed exchange, if you will, as part of the reorganization is treated as an exchange for purposes of the BEAT rules, and therefore that amortization that the U.S. taxpayer would have on that intellectual property would be subject to the BEAT.
Right.
And that could be, even more sometimes than the actual royalty that was being paid or whatever, BEAT consequences. And so I think there was some disincentive as a result of that rule for companies to bring that IP back. And I think what the final regulations told us is that, no, you can now, through a reorganization, bring back that IP to the U.S. subject to this anti-abuse rule.
Right. And similar to the treatment of 301 distributions. And so back in 2018, with the first set of proposed BEAT regulations, the government couldn't find a payment, if you will, with respect to 301 distributions. So there's quite a bit of discussion in the preamble to the final regulations about, somewhat nonsensical results with respect to treating 332 liquidations, in your example, differently than just a 301 distribution.
Yeah, if you just distribute at that, to your point, so instead of doing a liquidation or domestication, just distribute the asset up, and that's not subject to the rules, but that's because the statute actually says there needs to be an exchange.
Because, and, that being said, we've already, heard from government officials in public, panels or forums that form does matter from a BEAT perspective, but kind of, going back to the anti-abuse rule with respect to specified non-recognition transactions. So once again, those are only transactions that are in the sub-C, framework. Subchapter K non-recognition transactions don't qualify as specified non-recognition transactions. So thus you have a different analysis from a BEAT perspective. But to the extent you have a specified non-recognition transaction, but you have basis step up with respect to, the assets that are deemed exchange in connection with the specified non-recognition transaction, to the extent that a principal purpose with respect to, the basis step up is basically, avoiding any sort of additional U.S. tax under the BEAT. Your transaction falls outside of the helpful exception. And so not only do you have a principal purpose type of analysis that needs to be conducted with respect to any basis step-up planning occurring prior to one of these specified non-recognition transactions, there's also a per se component that basically deems abuse to the extent you have any basis step-up occurring 6 months prior to one of these specified non-recognition transactions. So you could have $1 of basis step up that's occurring because of a, related party sale of assets, which is not uncommon. And sometimes is not even really trackable. But to the extent that happens, it's, perceived to be abusive, and there's no de minimis exception that would, apply to $1 of basis step up or any sort of ordinary course exception. Once again, we're already seeing or reading in the tax press how government officials are, welcoming comments on the scope of the anti-abuse rule. Now, unfortunately, the anti-abuse rule is in the final regs, not in the proposed regulation. So it's something that perhaps we won't see additional guidance here, but until we do have more clarity, perhaps some relief. That is basically a final rule that taxpayers that are now, thinking I can plan, I can, bring IP home in one of these, sanctioned transactions, they're going to have to grapple with. But as we noted earlier, there could be other ways through distributions, other types of structuring that, taxpayers could utilize. It just makes the structuring a little bit more difficult.
Right. And companies need to make decisions. And I think this obviously isn't a regulatory issue. It's a statutory issue. But frankly, most jurisdictions, I actually can't think of any, deny the ability to be able to step up IP as it's brought into a particular country. And I wonder if this, legislative policy, is discouraging, certain U.S. MNCs or even foreign MNCs to bring IP back to the U.S. as opposed to another jurisdiction that would actually give you the amortization without having these other implications with respect to the BEAT. Now, that could all be changed on its head as a result of the OECD and Pillar 2 as other jurisdictions start to adopt minimum taxes and similar BEAT-type regimes. So it appears that the rest of the world may be following the U.S. and in our GILTI and BEAT regime, so that could certainly change that math. But I think at the current time, as taxpayers are thinking about where they want to have that IP, I think there is still some question whether, broadly the BEAT is consistent with that endeavor, that goal of trying to bring IP back to the U.S. Well, Nita, I think that is our time here. There's still obviously a ton of things to talk about. Lots has been written and many webcasts and the like on the BEAT regulations. But I think these are certainly some areas that many taxpayers and advisors are interested. So thank you very much for joining the Cross-Border Tax Talks.
Thanks for having me.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thanks again to Nita Asher, International Tax Partner in PwC's Washington National Tax Services Group. I'm Doug McHoney, PwC's International Tax Services Leader in the U.S. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.